Join us now to talk about the market's earnings and what's ahead. Victoria Greene, G Squared Private Wealth CIO and a CNBC contributor. We'll talk Tesla, talk about the airlines, everything else, Victoria. But 8 straight days in the Dow. When you're watching that happen, how are you feeling? Is there any FOMO in yet? Because we talk about it with you every time.
I know, and it feels actually pretty good because this is something we looked at. We wanted the market breadth to broaden out, and now we're seeing the value stocks work. Look at Johnson & Johnson reporting pretty strong numbers this morning, and so you're seeing the Dow do a little bit better while the NASDAQ is taking a little bit of a breather, and that's kind of a good thing because we wanted this breadth. We wanted value to participate. You know, if you look back at where we ended Q2, we really didn't have a lot of return in the Dow or the Russell 1000 value, both up 2-3% on the year. Suddenly now you're seeing the industrials, you're seeing some of these value components work better. Really great to see Johnson & Johnson perform well. We might see health and medical devices do better, a sector that's generally lagged this year. So it's a positive for the markets and that this rally can continue if this breadth continues to spread.
Yeah, I think the breadth was one of the reasons that were keeping you cautious on the markets. So, but now that the breadth is improving, isn't it too late for you to get bullish now?
Well, I mean, so I'm not as bullish, and I'm talking about taking profits from the mega caps that have run up, you know, and that's the risk you have with a Netflix and Tesla, which I still do like Netflix. But you want to be taking profits from overvalued prices that just can't afford to have any blemish on their earnings. They're priced to perfection, and look around the markets for areas that are a little bit more undervalued. And so the equal weight, the values, the small caps, some of those areas that haven't run up quite as much are a little bit more attractive. And they haven't, you know, if you look at price performance for the NASDAQ and the S&P, were up double digits. The value sectors and the small caps certainly were not. Now, small caps have been on a tear here in July, but I think there are opportunities. In the health sector has been beaten down. The real estate sector, typically, once we get to a pause, does tend to do better in a pause or a rate cut environment. And so some of these areas that have been unloved are areas investors should start considering.
I guess I'm asking that. I mean, you were kind of looking for a retest of the lows, right? At 3,800, were you looking for that? Now we're at risk of maybe breaking out the all-time highs. So
yeah, that looks like a pretty bad call.
Well, right. Well, when you say sell into this rally, you really don't have anything to sell, do you? Did you ever get bullish to actually put your clients into a lot?
Oh,
okay, so you had something, but just were cautious on the market overall for that rally.
Yes, and we were bullish coming into this year. We wrote it up. We just started trimming back and maybe called trimming back a little bit too early and started saying, hey, I'm getting worried on valuations. I'm getting worried on the breadth and concentration. And certainly we were saying, let's sell this rip. We're worried that this was not a sustainable rally. We have a lot of supports now between where we're trading and 3,800. So certainly I don't think we're going to get all the way back down there. But my concern is just if you were led up by the mega caps and the mega caps stumble like a Tesla, like a Netflix, it's harder for the market to rally in the second half. So you want to be pulling profits off of those. You know, when I was there about a month ago, I was talking about how much I love Netflix, still like that stock. But anytime you have these run-ups, you want to make sure you're buy low, sell high. Some of these places you may want to be taking profits from and looking for better parts of the market, cheaper parts of the market, and a little bit higher quality, more defensive parts of the market. So no, I don't think we'll see a retest of the lows at this point. We've got some good supports. The technicals are pretty strong right now on this rally, but I do think investors have to be cautious. Number one, buying mega cap tech at these valuations, and then number two, you know, throwing all in at this point. You just have to stay balanced. You still have a risk-free investment at 5% plus. You know, equity risk premium does get a little bit squeezed.
Yeah, I don't know where you'd go. If you went for 5%, if you go into 5% for a year or two, what's the reinvestment profile going to look like? I think that's why the longer dated bonds are so much lower. No one really expects that to, and then you'd have to hope the stock market came down because maybe you could go in then. But if the stock market keeps going up and you're going to end up a year later with 5% and nowhere to go for reinvestment, I think that's why the long end is down. That's why it's so inverted.
Yeah, and you haven't seen the 10-year move much. You've been stuck in this range of 370 to 4 on the 10-year because of those expectations have stayed very muted, and the expectations are still for rate cuts next year. And so the question is, why would the Fed be cutting rates? Why do you think he'll think there's reinvestment risk? And the reason the Fed cuts rates isn't because they're being nice to the stock market. The reason the Fed would cut rates is because the economy is stumbling and they need to now stimulate the economy, and that typically is bad for the stock market and bad for long duration stocks if you're seeing a lot of these pressures come on, and you are seeing the consumer squeezed a little bit, and that's why we're advising a little bit of moderation. I think investors at this point in a rally is typically where investors do get that FOMO itch, and then suddenly they throw all in because they feel like it'll never go down again, and then eventually the market does hit a wall and go down. So I think people just need to take some of these results with caution. You know, it does seem like the banks are telling us consumers are a little bit stressed, but you know, you are seeing decent results. So I'm not saying the end of the world is nigh, sell everything. I'm just saying don't get stuck in the everything's rallying, never going to go down again. That fever we felt in the early 2000s or the 1970s where it just felt like it couldn't fail. That is a dangerous part of the market to be investing in.